Imagine Federal Reserve Chair Jerome Powell at a press conference in September 2025. He announces a routine quarter-point interest rate cut, lowering rates to 4 to 4.25%. Then he says, "I think we were right to wait." The head of the world's most powerful central bank admits hesitation while the economy teeters on a knife edge. The Fed is trapped between two dangerous paths: economic collapse or runaway inflation. Unemployment is worsening faster than expected. Inflation is stubbornly high at 3.1%, above the Fed's 2% target. Any choice, raising, lowering, or holding rates, risks a crisis that could surpass 2008. Meanwhile, the U.S. government issues record debt. Foreign investors hold $9.13 trillion in U.S. Treasuries. But central banks haven't added significant net purchases since 2012. Some have even quietly sold portions. Private investors, hedge funds, pension funds, insurance companies, individuals must absorb over $5 trillion in debt that foreign governments used to buy. What happens if they decide U.S. debt isn't attractive anymore? Unlike governments, private investors care only about risk and return. The moment danger is sensed, they sell. This is the nightmare scenario Powell cannot say publicly. The U.S. runs annual deficits of over $2 trillion. Interest on debt already exceeds $1.1 trillion per year. Every 1% rise in Treasury yields adds roughly $370 billion to annual debt costs. If yields rise from 4.2% to 6%, an extra $740 billion goes to interest payments, money that could fund programs or reduce taxes instead of servicing debt. The Fed faces an impossible trilemma: raise rates to fight inflation but risk massive foreign selling and higher borrowing costs. Cut rates to stimulate, but weaken the dollar and accelerate inflation. Hold rates steady, and the economy slides toward recession. Every choice leads to instability. Powell's waiting was right as an admission the Fed has no good options. First cracks appeared at the April 7, 2025, Treasury auction. Demand was weaker than expected, and the Treasury OIS spread widened sharply, signaling institutional investor stress. Back in March 2020, similar stress nearly froze markets. Now, the Fed is removing $500 billion per year through quantitative tightening, leaving it unable to respond effectively. Former advisor Peter Orszag warns foreign governments could weaponize treasuries, selling bonds at a loss to apply geopolitical pressure. China already sold $54 billion in one quarter. If foreign holders sell trillions, bond prices collapse, yields soar, and mortgage rates spike, all while the Fed struggles to maintain control. The Treasury market is in a doom loop. Foreign selling pushes yields up. Debt costs explode. Deficits worsen. More bonds are issued. Higher yields are required. And systemic pressure increases. Internal splits add concern. In September 2025, Governor Stephen Moran voted against Powell's quarter-point cut, advocating for a half-point cut to prevent recession, showing Fed indecision. Powell projects unemployment rising to 4.5% by year-end, yet doubts further rate cuts. The Fed is torn between controlling inflation and avoiding recession. The first half of 2026 is critical. $2 trillion in Treasury issuance, $500 billion liquidity drain, and reduced foreign demand could cause auction failures or dramatically higher yields. At that point, the Fed faces two terrible choices: reverse tightening and risk runaway inflation, or maintain tightening and force a recession with soaring debt costs. There is no middle ground. Either path damages purchasing power, disrupts credit markets, and shakes the economy. Gold and alternative assets are already surging. Foreign selling, high deficits, Fed decisions, and liquidity removal are converging faster than most realize. Treasury market cracks. The Fed admits limited control. Your financial future retirement savings, mortgage rates, is directly affected. Decisions in Washington over the next quarters will determine inflation spikes, recession, or both. History, mathematics, and foreign investor behavior point to a critical turning point. Everyone holding dollars or treasuries is exposed. Your options: understand risks, adjust assets toward Real value gold. Productive businesses, inflation-resistant stores of value, and reduce exposure to long-term debt instruments. Ignoring these signs is betting the Fed will find a miracle solution. History and math suggest that bet is far too risky.